I'm going to jump into our two INV programs, the 5000 INV DTI and the 5000 INV programs. Again, you don't have an ATR issue because these are truly investor loans. On the first one, the 5000 INV, it's basically a no ratio, no income, no reserves, no employment. It's important to understand that. The element in this mix is, again, how can we do this? We could never do this if this loan was owner-occupied. This will lead to some guidelines you need to be aware of in this program. But with that said, the employment information is put on the loan application with a phone number just for servicing purposes. We do not verify employment, whether the borrower is W-2 or self-employed. It's simply there for information purposes down the road should the borrower ever need to be contacted outside of their home number. That's all it's there for. The income is not listed at all. The borrower's assets are not really needed except in a purchase transaction to cover down payment, closing costs, and prepaid expenses. Beyond that, the 5000 INV program has no reserve requirements. It's as basic as you can get. There are two elements to be aware of, or actually maybe a few more than two, but two high-level elements to be aware of. For a U.S. borrower, and as some of you are aware, the INV has a foreign national element to it. I'm not going to talk about that right now. But for a U.S. borrower, we require, again, this leads to ATR. We require the borrower to basically own their primary residence. Why do we require that? First of all, we don't need them to have a loan, but we need them to own the property. And that's for ATR purposes. Now, you may ask, why does it matter if they own their home? Because we don't want to see the borrower using this loan program to get around regulations and then move into the property. The idea is that a borrower that owns their own home, regardless of whether they have a loan on it or not, they're buying an investment property. Now, we will look closely to determine the investment property if it looks like it's really a primary residence or not. What do I mean by that? A borrower owns a home that is worth $200,000 and they're buying an investment property worth $400,000. Their primary residence is 1,500 square feet. The investment property is 3,000 square feet, and this home that they're buying as an investment is only 4 miles away. This looks like the borrower is buying a new home to move into. So we're going to look closely at these elements to make sure that when a borrower is buying a property under this 5000 INV program, that it truly fits the scenario of an investment purchase. Again, why is it important for us that the borrower owns their primary residence? Because we want to, as much as possible, avoid the risk of a renter using this program to buy their primary residence. As such, the borrower does not need to have a loan on their primary residence, but just needs to own the home. Obviously, if they have a loan, if they have a mortgage, we need a mortgage rating, and we have requirements for those mortgage ratings. The second aspect of this program to be aware of is that there are limitations for borrowers that are first-time investors. So there is a restriction, an LTV cap for a borrower that's a first-time investor. You're not going to get the max LTV on this program unless the borrower can demonstrate that they've been an investor within the last 12 months. They don't need to currently own an investment property, but they need to have owned an investment property in the last 12 months. So if a borrower sold an investment property 3 months ago, but they owned it for 2 years prior, that's totally fine. That is not a first-time investor. What we will need documentation to support that. Let's assume that they sold the property 3 months ago and they no longer have an investment property with the exception of their primary residence. That's not an investment. Their home is not an investment property. So we would ask for a final closing statement. We would look to have some sort of a history on mortgage payments, and we would probably want a property profile to show that they own this property for a period of time to demonstrate that they're not a first-time investor. That's how we would document that issue. Again, we're looking in the last 12 months, they had to have owned an investment property at the time they're doing a new loan with us, they may be buying a new investment property. They don't need to own any prior ones as long as they had it in investment property within the last 12 months. And by the way, they don't need to have owned a residential property. It could have been a commercial property. Maybe they owned a store. Maybe they owned some commercial investment property. Just remember that any properties listed on the REO that they currently own, other investment properties, will need to have mortgage rating. Also understand that any loans that are through a private party or rentals that are on a private party will require 12 months canceled checks on all programs and 12 months canceled checks and VOR and or VOM if they are not reported on the credit report. That's extremely important to realize. So these are some elements to understand regarding the 5000 INV. Now, it's important to understand some nice features under this program, which is the 5000 INV FN, which is for foreign national borrowers. The issue of ATR is somewhat mute for a foreign national borrower because the ability for them to buy the property and move into and try to trick us is not likely if they live in another country. So we're not as sensitive to them owning their own home if they're a foreign national borrower in another country. We will allow the exception of a foreign national borrower in another country to be renting. However, they're going to be dealt with in the same manner that they will have to demonstrate that they are not a first-time investor to get the maximum LTV per the program. Otherwise, LTV drops for first-time investors. Obviously, if they own other investment properties, we're going to want mortgage ratings on that. And by the way, all the properties that they own should be listed on the REO schedule. We don't care about taxes and insurance. All we want is the address and the mortgage, and we want a mortgage rating on that property. So we don't need a tax bill, we don't need insurance, we don't need deck paid, we don't need anything on any other properties except our subject property. That's applying to both the 5000 INV and the 5000 INV DTI. The foreign national program is very unique because it allows the borrower a foreign national borrower to buy an investment property in the U.S. without any income documentation, any questions about their employment. The only thing that's important is that they need to have a U.S. bank account and they need to transfer that money to the U.S. There is no seasoning requirement on that program for the foreign national borrower. They need to transfer the money to a U.S. bank and they need to use that money to put into closing and or escrow at the time that we're closing the transaction. The purposes of these rules relate to anti-money laundering and all kinds of issues regarding the Patriot Act. So that's the scenario with the 5000 INV. The 5000 INV DTI goes back to what I said earlier. The higher the documentation and requirements, the better the pricing. The reason the second program is in place is to provide an interest rate for the more seasoned investor and provide an opportunity for them to take advantage of their credit, assets, and so on and so forth to be able to get better pricing. You will find that, depending on the scenario, the 5000 INV DTI is actually 0.5 to 0.75% better than the regular 5000 INV. With that comes some additional items to be aware of. All of the scenarios that I described on the 5000 INV apply. However, you do have 12 months reserves on the 5000 INV DTI. You do have a necessity to actually qualify based on the cash flow of the property. Again, the DTI that we use under the 5000 INV DTI is not based on the borrower's income, it's based on the property income. So in the case of a purchase transaction, as part of that formula, we're using the rental survey to determine the income. The debt is made up of the mortgage, taxes, insurance, homeowners fees if there is one, and that's the formula. And I'll have you look at the guidelines, and the matrices will tell you based on what FICO score, what DTI is allowed. So a very simple formula is that if the borrower, for example, has $1 rental income, it's allowed that you can go up to 80% of that for expenses on a monthly basis. That's how we calculate the DTI. So your monthly mortgage, taxes, insurance cannot exceed at the highest level in the guidelines more than 80 cents compared to the $1 rental. That's how the DTI is calculated. It's a very simple formula, and it's based on the subject property. We do not look at the borrower's income. We do not look at the borrower's other properties. All we care about is the subject property. Now, it's important to understand that the 12 months reserves is either going to be on the subject property or any other loans done under the same program. So if the borrower has 10 investment properties and we've only done 2 of them under this program, we will only require 12 months reserves on the 2 loans that we've done. We will not ask for 12 months reserves on the other 8. It's important to understand the reserve requirements in this case. Again, the same philosophy of first-time home buyer applies, and the same concept of the first-time investor qualifies. You need to study the guidelines closely to understand the program, and you need to study that in order to understand the differences between these 2 programs. Again, higher standards, better pricing, better terms.